Well, if you look at financial markets, they seem to be indicating that something is going wrong in the global economy. Our measure of global risk appetite has moved into panic in the last few weeks, and in particular that looks to be associated with the drop in the oil price and with uncertainty over China. However, if you look at actually what's happening in the global economy, it looks nothing like as grim as the market movements we're seeing, and also much more varied. If you look at overall global GDP, our forecast is still for the global economy to grow at 2.7% in 2016 compared to 2.5% last year. But if you look at the history of the last 5 or 6 years, the habit has been for those relatively optimistic growth forecasts to be systematically downgraded year after year. So it may well be that the market has started to anticipate that we're going to have to cut our forecasts again. I think there are risks at the moment, but at the moment we don't think the economy is about to dip into a slowdown or recession. China's slowdown continues to develop, but from what we can see from the data, it is still not a precipitous or sharp slowdown by any means. But if you look at what the Chinese authorities are planning for their economy this year, it does seem to point in the direction of further weakness. So what does that mean for the rest of the global economy? Well, I think there are two key negative impacts from that. The first is through the commodity complex. And if you look at our forecasts for countries such as Brazil, South Africa and Russia, we've downgraded those pretty significantly over the last 2 or 3 months. The second area of weakness is likely to be in Asia itself. We've seen over the last decade or so a huge increase in intra-regional trade, and as Chinese slowdown has developed, we've seen trade volumes in the region slump, and that's likely to affect growth and demand across the region. Well, if you look at the US and Europe, what's interesting is that their economies continue to look very resilient. Domestic demand in the region is doing considerably better than it is in emerging markets. That said, I think the volatility at the moment continues to pose risks, and I think there are 3 that I see out there for the developed economies. The first is obviously financial conditions. We have financial markets in panic at the moment, and I think the ongoing tightening, particularly in US credit markets, is something of a problem if it feeds through into tighter borrowing conditions for corporates. The second channel's just pure business confidence or animal spirits. As financial markets are in panic, it's possible that the sort of fragile fabric of business confidence is torn. And my third risk is actually that even though we see that real GDP growth is looking pretty firm at the moment in the US and Europe, nominal GDP growth, cash GDP, is actually sluggish globally and has slowed quite a lot. And for me, that's a sign that the scope for the economy to deliver increases in corporate profits or increases in wages is becoming much more limited. And it's the former really that worries me the most. If you're starting to see a squeeze on corporate earnings in the US and Europe, that could lead to a change in corporate behaviour. And generally, if you're worried about slowdowns or recessions, it's the corporate sector that tends to generate them. It's cuts in their spending that lead to the downturn. For the Fed, we still think they're moving to normalise rates, and we think that the volatility we're seeing over the past few weeks is only likely to lead them to pause that tightening process in the first quarter. And we think if the financial markets and crucially the economy remain resilient, then there is still scope for the Fed to raise rates later in the year. In Europe, even though the recovery is pretty robust, what's interesting is that it's still very immature, and of course that economic weakness is pregnant with political risk, as we continue to see in elections in southern Europe. So for the ECB, it's absolutely vital that they continue to underwrite that recovery, and I think the uncertainty, along with obviously continued low inflation thanks to the oil price, means that the ECB can continue to act to stimulate the economy. So we're looking for them to cut rates in March and potentially deliver faster asset purchases.